I'm Kara Murphy, and this is Money with Murphy. Let's talk about the Treasury market, which has enjoyed an unusual level of excitement over the last few trading days. Last week, Fitch Ratings announced that they had downgraded U.S. government debt from its highest rating of AAA to AA+. Over the next 2 days, the yield on the 10-year Treasury bond rose by 15 basis points, or 0.15%. Then, fresh economic data suggested that new job growth was slowing even as wages increased. With that, yields turned in the other direction, this time dropping by 10 basis points in a single day. These moves highlight some of the forces playing out on the long end of the Treasury yield curve. So let's first talk about where long-term interest rates are relative to history. The move last week brought 10-year yields to almost 4.2%. which is near the peak that we saw in October of last year and among the highest yields we've seen since 2011. Current levels are twice the pre-COVID level and 8 times the low during COVID. So it's safe to say that long-term interest rates over the last year or so have been markedly higher than recent memory. While the Federal Reserve controls very short-term interest rates, long-term interest rates are free to move higher and lower. So why are rates higher? One driver is inflation. Even though inflation levels have subsided from their eye-popping rates just a year ago, prices are still increasing at a faster pace than we've become accustomed to. What's even more important to long-term interest rates is not just what inflation is doing today, but what the market expects it to be years out. Interestingly, those long-term expectations, as measured by what we call the 5-year forward break-even rate. I know, not very creative. That rate has jumped meaningfully in the last 3 weeks, meaning that only recently have investors begun to think inflation will be higher for longer, helping to drive those long-term interest rates up. Another driver is the amount of new debt that the U.S. Treasury is expected to issue through the end of the year. In the third quarter alone, Treasury is expected to borrow $1 trillion. Now that's up from about $700 million in each of the last 2 quarters. Looking forward, those borrowing needs are expected to continue to increase. A third driver actually comes from outside the U.S. and Japan. After many years of near zero interest rates, the Bank of Japan announced that they had effectively raised the interest rate cap from 0.5% to 1.0%. That may not sound like much, but Japanese buyers make up a large portion of U.S. Treasury debt purchases. If those buyers now have somewhat more attractive yields at home, they may choose to shift some of those purchases from U.S. bonds to Japanese bonds. So what happens from here? Despite these challenges, there are offsetting factors that may offer investors attractive opportunities. For one, the bulk of Federal Reserve tightening is behind us, and higher interest rates provide helpful income to investors. We recommend a diversified basket of bonds of varying maturities and different asset types so investors can capture those opportunities over the long term. Until next time, invest wisely and live richly.